I spent the last 3 days analyzing gaps, and I've come to the conclusion, why doesn't everyone rely on them more often? In fact, everyone is always looking for their next indicator to use to try to predict the future, but they always look at traditional indicators, like the RSI or the MACD. You see, if you've been trading for a while, you've probably heard of the saying, all gaps get filled. Well, there's some truth to that. Let me prove to you how powerful gaps actually are with some simple statistics. But first, let's understand what a gap actually is in the stock market. A gap occurs when there's a difference in price between two trading periods, with no trading happening between those prices, creating what appears to be a gap in the chart. A gap can also be partially filled or completely filled in the future. A gap usually forms after a company reports earnings, significant news comes out, or an analyst upgrades or downgrades the stock. But in reality, it doesn't matter the reason. Gaps will fill most of the time. In fact, they are one of the most probable occurrences in the market. Let me prove it to you. Tesla is one of my favorite stocks, so I'll use it as an example. I made this advanced trading view indicator that lets me easily spot gaps. But most importantly, I've calculated these statistics. As you can see, Tesla has created 355 gaps historically and filled 326 of them. That's a 91.83% fill rate. And the S&P 500 fills 93.7% of gaps. Gap fills are nearly inevitable, and we can use this to our financial benefit. More on this later. For your knowledge, here's a table of some important tickers along with their historical gap fill percentage. Now, why does this happen? Why do gap fills in the stock market have such a high probability? There are a few reasons, but I'll focus on one of the more important ones. But first, understand this. The algorithms that control the stock market have a common goal, which is to benefit the wealthy hedge funds and private equity firms, not you, the retail trader. As a result, those algorithms will treat gaps as a magnet. Let's look at this example of a short-term gap fill. Remember, gaps are formed based on news. The Nasdaq gapped up on this day because of positive news and sentiment that the Fed will cut rates this year. Referencing my TradingView indicator from earlier, QQQ at a 15-minute time frame is filling gaps 89.5% of the time. So we know there's a high probability that price will find its way into filling a previously opened gap. Utilizing gaps as part of your trading strategy not only aligns with statistical probabilities, but also adds a layer of sophistication to your analysis. A key part of technical analysis is combining catalysts to increase your winning probability. For example, here we see a potential gap fill happening. Before we take a trade, we can observe the MACD cross to the downside, and the TTM squeeze is suggesting a bearish trend. That's two indicators suggesting price will go down, so we take a trade short. A simple place to take profits is when the gap is completely filled. This is a 15-minute time frame example. Now let's quickly view a gap fill based on a longer time frame. The thing with long-term gaps is that they can be filled days, weeks, or months later. Here's an example of a daily gap where Microsoft filled it 86 days later. One of the simplest ways to trade a chart like this is to not buy in this uptrend if you're a long-term investor. Instead, we know that Microsoft fills daily gaps 92% of the time. So, you would wait until price revisits this gap and have a better entry than buying up here. There's no such thing as a perfect indicator, but there are very few things in the stock market that are very close to perfect, and one of those is gaps. Incorporate them into your trading strategy, and you're a step closer to developing a dominant trading approach. I hope you found this video valuable. See you next time.